Hey everyone, me Kevin here. We've got to go through the CPI numbers, and I wanted to get them out to you before we take off, so I thought I'd go out here and get you a video. Boy, this is, by the way, about the 100th flight I've taken this year so far, and I've seen so much from all of you in person, been meeting course members, agents. Thank you so much to all of you. None of this would be possible without you, and I know there's a lot of uncertainty right now with what's going on, especially since we started seeing stocks fall again, so I wanted to talk about, obviously, CPI projections. We're going to go through the JPM CPI projections, then we'll also go through Goldman projections. The CPI projections are a big deal. They're going to be absolutely one of the reasons why we are seeing a soft market right now. Because look, how could you buy right before your CPI data release? People need that additional confidence that we are indeed on a disinflationary path. And there is a chance that we are going to get rocky CPI reports. Any rocky CPI report coming up is going to be a horrible negative catalyst, especially with fears that the unemployment recession is still above or ahead of us. This morning, I filmed a video talking about how that unemployment recession could be ahead of us. And some of you actually, very smart. I appreciate y'all. I appreciate the critical thinking. Some of you were asking me, because we looked at the unemployment chart, and how when employment rises above the moving average, the simple moving average, we tend to see a recession soon after. And we've recently had that. However, some of you had asked, well, what about the other times it's moved above the moving average and we didn't have a recession after? Those instances occurred right after a previous recession, which somewhat implies some volatility happening right after a recession. I personally believe that there is a possibility that is the volatility we're getting after the COVID recession, or it is a red flag of things to come. In other words, we have no freaking idea. And that's why we're so reliant on any data we can get to assuage our fears, so to speak, that, hey, we're not going into a big, dark, ugly recession. I will tell you, though, and this was a red flag, and this is another red flag. It was the first time I've heard somebody say this. An agent told me today in Arizona, that's where I am right now, it's hot, okay, I'm wearing my shorts, all right? In Arizona, I had an agent say, Kevin, we're starting to see a little bit of an uptick in some defaults. I go, really? You know, I'm generally not seeing that other than, COVID normalization. And they said, it's not going to show up in the data yet. The defaults that I'm seeing are just now coming through from people who bought last year. And then I go, holy crap. Those are people who bought at 6-7% interest rates, thinking they'd be able to refinance within the next 3 to 6 months. Rates stayed higher for longer, and now they're like, crap, can't afford this payment. Red flag. Could happen. So there's always mixed data and uncertainty. I'll tell you, there's always a reason to be fearful. There's never going to be a lack of bad news. And I like to be aware of it because obviously when there's a confluence of too much bad news, you can actually have a very bad economic forecast, and that's not great. Running the different businesses I do, I always like to be as attuned as possible. Holy smokes. I hope you can't hear him, but there's a jet pulling up next to me right there. It is so loud. There's a chance you might not hear it too well because of the mic. But anyway, let's get into the CPI analysis. So, CPI scenario analysis from JP Morgan. JP Morgan Research, we have a 5% chance of getting a greater than 0.4% month-over-month core. That is a tail risk scenario, and JP Morgan is warning that for us to see that happen, we would have to have a higher expected core along with hotter autos. That's a big focus right now. Goldman Sachs actually thinks we're going to come in low on the CPI forecast. And when we come in low on that forecast, it's going to be driven by lower used and new auto prices. So that'll be a big weight down, even though we're dealing with some positive base effects that are going to push us up. But JPM only thinking we're going to have a 5% chance of getting a greater than 0.4% read on that month-over-month number. They do think there is a 22.5% chance of getting something between 0.2 and 0.4%. And they suggest that this could actually rattle the disinflation narrative a little bit. You could see the SPY fall anywhere from 1 to 1.5%. If you get something like 0.4 or higher on core, you're probably going to get more like a 2+% decline in the S&P. Not great. But they have a 45% chance of honestly just getting an expectation CPI read tomorrow. I will be live for CPI tomorrow, and I have an announcement for everyone tomorrow, which I'm very excited about. So I look forward to seeing you at tomorrow's CPI. That'll be 5:30 a.m. or obviously catch the replay if you want to sleep in a little bit. I don't blame you, although it is going to be very exciting. 25% chance of actually having a below read of 0.1 to 0.2, consensus being 0.2. Any read of 0.1 to 0.2. Wow, okay, that was unexpected. I actually had to cut because apparently the phone overheated thanks to it being 109 degrees out on the tarmac. So, picking up where we were, 25% chance of getting a between 0.1 to 0.2%, cementing the disinflation story, suggests JPM, and could potentially launch the view that the Fed would be closer to declaring mission accomplished, potentially getting us closer to finally cutting, or at least having a path towards cutting. I think a lot of folks are really excited about that because once we get on the path to cutting, we can then really argue, okay, we can get back to credit expansion, we can call the EPS troughs in stocks that we've seen, and then we'll certainly get a lot more enthusiasm in the cyclical trades as well, whether that's your solar, your automotive, or other highly interest rate sensitive sectors. There's only about a 2.5% chance of getting a print below 0.1% per JPM. Personally, I'm leaning to something like a 0.15, so we'll have to actually look at the actual number and do the math on it because they'll round that to 0.2, but I'm leaning myself to a core of slightly below 0.2. I actually think we're really going to cement that disinflation story. If we don't, though, we've got some real risks. Of course, as we know, one report doesn't make a trend, so one bad report tomorrow won't necessarily confirm that, inflation's skyrocketing or something like that, which we don't expect. But any kind of read over 0.2 on core will certainly jolt the market at a time where people are already a little, gun shy, especially after the Fitch downgrade. It was not great. Even though nobody really cares about Fitch, the downgrade definitely came at not the most ideal time since we just peaked out in stocks here locally on June 19th, Tesla earnings day. Almost the entire stock market peaked out and started trending down from there. So CPI consensus, and I want to get into Goldman as well. Consensus, we're looking at 0.2 month over month. That's for headline month over month. Core month over month is 0.2. Year over year, 3.3. Get a little bit of an addition there because from the prior read of 3, thanks to energy prices, oil starting to trend up again, despite the Chinese disinflation story. Kathy Wood calling for China exporting disinflation, if not even deflation. Core CPI year over year expected to come in at 4.7, which strips out those volatile food energy components versus the prior of 4.8. Okay, now we're going to look at Goldman here. So Goldman had an interesting POV. Goldman research actually also argues for a 0.15% increase. Again, that's going to look like 0.2 when we first read it off. Then we'll do the math and we'll see. They think the year over year will come in at 4.66 versus the 4.8 consensus. 4.8 to 4.7, depending on what time of day you look at the consensus. I align with Goldman on this, and I don't always align with Goldman, but Goldman's the other research institution that I really appreciated when they argued that stocks tend to bottom about 6 to 9 months before you actually get a bottom in earnings, which would somewhat align with a bottom in earnings in Q2, Q3 here, stock market bottom around Q4 of 2022. Goldman Sachs arguing for a 3% decline in used car prices, 0.3% decline in new car prices, reflecting lower used car auction prices and continued increases in dealer promotional activity. They also think we'll have some downward revisions, which I was surprised by, in apparel and lodging prices. I was expecting maybe a little bit more of a push to the upside on lodging and travel and hospitality because of summer travel seasons, and this season potentially being more in demand than previous seasons. However, much of the summer travel has actually been for international destinations, which could potentially reduce that inflation here in America, or that inflationary impetus you would get in those categories. Shelter inflation to remain roughly on pace, coming in maybe at about 0.44 is Goldman's estimate. They believe that if we get any read over 0.3, will be negative 1.5% on the S&P. Anything really 0.2.5 or less will be positive, because it'll really reiterate lower car prices, lower shelter inflation, less wage inflation. Remember, we want to see people make more money over time, but we don't want that to disanchor to where all of a sudden we're facing potential wage price spiral, though that has not been the case at all this cycle. Those fears existed quite well early 2022, but have not proven to be most accurate. After that, we have PPI coming out the very next day. So we'll have CPI tomorrow. The very next day, we'll have PPI coming out. I'll give you quickly the expectations for PPI. Less people care about this one, but usually people like to say PPI leads to CPI. So this is your producer price inflation number, survey month over month 0.2, core 0.2, and then you're looking at final demand year over year 0.7. That's year over year. That's less than 2%, right? And then core PPI dropping to 2.3 from 2.4. Then very next, actually just a little bit later that day, we will be getting our University of Michigan sentiment read 5:30 a.m. tomorrow for PPI tomorrow 5:30 a.m. Sorry, what am I saying? CPI tomorrow, 5:30 a.m. The next morning, 5:30 a.m., PPI. Then 7 a.m., the University of Michigan sentiment read, looking for 1 year to stay stable at about 3.5. That's a tick up from 3.4 for the 1 year inflation read, but that long term, which is the important one, staying anchored at about 3%. Remember, that's part of how JPOW likes to calculate what the FOMC rates should be, using a restrictive level of about 2.5%. Add in the longer term inflation expectation of 3. There's your terminal Fed funds rate. So eventually we expect that inflation expectation to come down along with the level of restrictiveness that the Fed believes they need. So we might see that lead to rate cuts next year, although the estimates for that vary. It could be March, it could be July. What I've found is more patience is required for everything. I think that's true with real estate. I think that's required for the stock market, for everything. So this gives you a breakdown of CPI expectations as well as PPI expectations. So I'll see you tomorrow at 5:30 a.m. Thanks so much for watching. Make sure to subscribe, and we got a big announcement tomorrow as well, right around CPI time, 5:30. So I'll be making that announcement. We'll see you there. Thanks. Bye.